If you're seeking to raise capital from VCs, you need to be prepared. Do not hit the market without having an answer to these 5 questions. Today, I'm joined by Antonio Barzagli, our fellow growth thinker who oversees our London office for Growthink Consulting and Growthink Capital. Antonio, welcome to the show.
Thank you, Tim. Pleasure to be here.
Yeah, so raising capital from VCs is not for the faint of heart. And we see it all the time where well-meaning entrepreneurs who have great companies simply don't know how to message themselves. And, quite frankly, they're not prepared to answer hard-hitting questions from VCs. So what I thought we'd do today is just kind of walk through the top 5 hard-hitting questions that we see time and time again VCs ask. So taking it from the top, what is one of these hard-hitting questions that you see consistently?
Sure. I thought I'll start from one that I believe is massively underrated, one that many consider a box to tick or to check, but I believe is crucially important. What is the market you compete in like? To answer this, you got to start thinking about how venture capital think and what they invest in, right? They like to put their money, most of them, on future unicorns. And to achieve a $1 billion valuation, which is the definition of unicorn, you need to get to enough revenue or profits to be valued as such. So take an example of a software company or a SaaS company. And let's say that company will be valued 7 times the annual recurring revenue or ARR. They don't need to be at approximately 150 million in revenue per year to be valued over $1 billion. Why is this important? Because if your market is 200 million or 300 million, that will likely not be enough of a market to get to that scale. You probably need a market of 2 billion or more. As a short example, take the fast food industry in the US, which is worth approximately 400 billion. That is the sum of the revenue of all companies in that industry. If my company supplies burger buns to that industry, the bread for hamburgers, my total market size or TAM is not going to be 400 billion. It's going to be a rather small fraction of that massive market. And an easy way to calculate your total market, which applies, I think, to mostly any company in any industry, in any geography, is take your average annual order per client, multiply that by all of the clients in the industry, all the clients that you could sell to if you had 100% of market share. Okay. The other super important consideration related to this is whether your market is growing or shrinking, with the latter being possibly a concern to VCs or an investor. So asking this question allows a venture capitalist to understand also how you're thinking about your customers and the segments that make up your target market.
Yeah, that's a great point, because how many times do we see someone says, hey, our market is $300 million and we think we're going to be a unicorn and we think we're going to capture 20-30% of the total market. And then you look at their sales and marketing plan and it's not really mapped out appropriately. And you're like, how could you be a $1 billion company in a $300 million market? I mean, some things just don't make sense. Some dots simply don't connect. I think there's tons of value for hiring someone like Growthink to go in and do the market research and really determine what that total addressable market is. Then you also have your serviceable, obtainable market, right? You kind of shrink your circles down. You say, well, we think we can target this.
Yeah.
Going a little deeper down that rabbit hole, why don't you think entrepreneurs take a moment and really understand their market? Do you think they're focused on the wrong things?
I think it's, well, some do, first of all, but a lot of entrepreneurs are very excited about getting it done, right? Testing the waters and selling their products, building more products. So, but I think you're bringing up a good point, because that exercise of calculating your market size, it's also a reality check that can point you in another direction, right? If you run the numbers, do research, and realize that you are in a market that is too niche, you could look at what other markets adjacent to where I am now I could serve with the same or with minor changes to my current product and service offering. So it's a very good exercise to do internally before speaking to any investor altogether.
So understanding that the VCs are looking for at least the unicorn, the billion-dollar unicorn. Now, that's not to say that there's not some VCs out there that would be interested in something less than that. But for the big guys, the big players, that's typically their appetite, correct?
Yes, yes. Again, we could talk for a long time about this. One thing I'll say is that there are in this year, last year, in recent times, some of the mindset has shifted with some venture capital or growth capital investors thinking more about responsible growth, maybe being happy with relatively smaller markets, smaller growth rates, but a more efficient use of capital. So we don't want to generalize saying VCs only invest in unicorns, but being part of a market that is large enough to enjoy sustainable success, it's a very healthy consideration to be aware of generally, regardless of what investors you plan on working with.
Okay, so that's question number one. What's next?
Number two is, what's your traction like? Okay, and this is maybe sometimes question number one, but this is hugely important. It's easy to get lost in the immense potential that my startup has, right? And don't get me wrong, because VCs are having that conversation with you because of the potential, probably not because of the scale you achieved. They're not cash flow buyers. They're in there for the potential that your company can achieve. But your current traction is the only undebatable evidence that the market needs and likes what you're doing. It's a de-risking factor for them, right? So you need to be prepared to discuss your sales or your revenue over the past 3 years. And that is because sometimes you have a bump year. And so they want to usually look at the trajectory over the last years and the current year, right? It's mid-August almost, and we're close to the end of the year. Understand where you are now. It's a good indicator for 2024. You need to know your burn, your monthly loss, you could say. You need to, if you aren't profitable, when will you be profitable, with or without infusion of capital? You need to know very well your gross margins. Even better, the gross margins by revenue stream, if you have multiple ones. You should know your unit economics, right? Hugely important to explain how it works and also to understand marginality. And also, I would say that in some cases, in most cases, if your proof of concept isn't demonstrated by substantial adoption and revenue, you might be too early for venture capital money, right? That doesn't mean you can't raise capital. But it might be through other channels, or it might be after you reach a certain threshold, right?
Yeah, and not all traction is equal, right?
Mm-hmm.
I've seen sometimes, from putting on my investor hat, I just look at the momentum holistically, and then I look at the momentum in silos. So the momentum of your sales, the more momentum of your marketing and your market share, the momentum of, let's say, maybe even pushing your OpEx down, or the momentum of bringing on new team members, the momentum of solidifying new strategic partnerships, new distributors, new vendors, the momentum of finally getting your IP that you had a patent pending on, the momentum of maybe the momentum of taking on more additional capital, right? Maybe open up debt lines and bringing on friends and family. And there's all this momentum. And I look at that momentum as traction as well. It's not just, did we sell more this month?
Yes. Thank you for reminding me how superficial my answer was, but I fully agree. Different industries, first of all, have different type of traction. Take, for example, biotech or pharma, right? You're probably not going to see any revenue for years and for many funding rounds. And the regulatory approval, milestones within that is substantial traction, right? And those companies behave a little bit differently. Other times, I would say that a joint venture, a partnership, changing your operations and moving from, say, a manufacturer to another, that could be a critical moment in transforming the growth of your company. So I don't want to reduce it to revenue and contracts, but it is an indicator that will come up and will come up again every time. So want to at the very least be prepared to articulate where you are.
Right. And there's different types of traction for the early stage companies. If we're talking about venture capital, we're probably going to look at certain milestones or
Yeah,
KPIs for the earlier stage company, let's say 3, 4 years or less, versus a lot of the legacy businesses that we look at. Traction for a company that's been around for 50 years could look very
yeah,
different, wildly. Maybe it's more M&A focused, whereas
absolutely.
these early stage companies, it could be something as simple as, we hired a new C-suite member. That could be big momentum for somebody.
Yeah,
Well, that kind of moves into one of the questions, one of the top VC questions that we were talking about earlier, which is how? How does this happen? How does
yeah,
this work? How does it all come together? The big how. It's kind of an existential as much as a tactical question.
yeah. Just one word, three letters, and a lot of challenges to answer that, right? Because you probably just presented some nice projections pointing up to the sky, and you're asking for several millions of investment to get to that performance, right? But how you're going to get it done, it's far more complicated. And first of all, delivering growth is super hard. Delivering growth at scale and consistently, even harder. And so, you need to articulate in a very tangible, pragmatical way the steps of your growth roadmap and break it down into intermediate milestones, right? Because it'll be quarterly, monthly, weekly actions that lead to results that ultimately lead to that performance that you and the investors are looking for. But also, who's supporting you in the execution? You can't think that the two founding members in that famous garage are the only people that will be involved in growing the company from seed to Series A to Series B and down further down the line, right? So partners, employees, other help. And also, what confidence do you have in these results that you're presenting, right? Are they based on data? On what data? And I don't know if you heard this, Tim, but I know you're spending a lot of your time in digital marketing. And so you probably heard this a lot of time, but we've grown until this point without any marketing budget. So, Mr. Investor, with your capital, we'll put your capital to marketing and it'll be very easy to grow, right? All we need is your capital. That's wrong, right? Because it's not easy. The fact that you haven't done any marketing in the past, it doesn't say that it's going to work. In fact, if anything, it says that you don't know how to do it, right? That's the only thing we know. So in reality, it's about, are you going to do inbound, outbound, what channels, what campaigns, who's going to write those campaigns, right? And it's very easy to waste investors' money thinking that you just push a button and it produces customers, than giving a return on that capital.
Yeah, there's so many factors that sophisticated VCs consider that first time and early stage entrepreneurs, they just haven't had those battles before. I'm not talking about seasoned entrepreneurs that have had every battle imaginable for 20, 30 years, and this is their fifth rodeo. And, those people, it's easy to hedge your bet with them in some regard because they know what they're doing. The early
Yeah,
stage entrepreneurs, sometimes they don't know even HR issues or legal issues that are coming down the pipe for them, or supply chain issues, or they haven't faced the first global meltdown or a pandemic or a market crash or things of this nature. So a lot of this is new. My question at the highest level is always how long and how much, right? And this is where I
mm-hmm.
like giving money in tranches. So if somebody's saying, hey, we want to raise $10 million for our startup or for X period, I say, great, you don't need $10 million today. Let's be honest, you could
Yeah,
probably start with $500,000 and then call me. Even if I give you the commitment, let's just start you off with $500,000, a
right.
million. Let me see 4 or 5 milestones completed. Then I'll release another million or two, and then we'll hit more milestones. You know
Yeah,
what? If you actually successfully hit your milestones, you may not even need the whole $10 million. So even
yeah,
though this is
absolutely.
my brain, the way that I think about it, and then I get deep in the weeds. And you and I are both We come from the school of hard analysis. I mean, we can tear apart a spreadsheet 20 different ways. And I expect the entrepreneur to do the same. I expect them to know their
Yeah.
unit economics and look
Yeah.
at scenarios. And one of the things you were kind of alluding to, which I believe is one of your fourth questions here, is, well, what happens if your how doesn't work out? What
Yeah.
happens with your
And
contingency?
you're going exactly in that direction. I just want to make one last point before we transition it to number four. About what I was saying before, having grown to that company without capital, just want to be clear. That is huge. First of all, it's a great thing that having been able to get to that point without any external capital or much external capital, because venture capital investors, they love bootstrap companies, right? It means that you are a responsible entrepreneur, you're capital efficient, your cap table is probably clean or cleaner than others, and so that is a great point. Okay. But my overarching point about the how is that you need to articulate it very pragmatically how you're going to deliver those results, and you need to have a strong strategic plan or growth plan in place in order to raise. You need to have that plan with full buy-in from your stakeholders and team, and then only at that point you pitch it if you want an investor to believe you in the pitch. So that's all I
Let's
wanted
stay
to add.
here just for a hot second on this how, because I love the how. What would you recommend to those listening here as a best practice for what does this how look like? Is it, is it a dictionary looking business plan? Is it a one pager? Is it one slide with 5 bullets? Like, what constitutes the how? What will scratch the itch from what you see on a daily basis?
Huh. So I learned over the years, I think that brevity, as Jay says, brevity is next to godliness. And there's something powerful in being concise, which is most of the fact that everybody can quickly absorb a concept, right? But also that if you have to describe in a slide or in 2 slides the how, right, that limited space forces you to really distill what you're going to do to um the only important things that you're going to do, which is probably not going to be more than 2 or 3, 4 things, right? So I do like that format, which is more than a Bible for execution. It's a framework for a discussion with your team or with investors.
By the way, a lot of it comes down to testing, which
Yes.
is, I think there's something to be said for honesty, right? Because the VCs, for the most part, smart, intelligent, we all kind of
Mm-hmm.
get it, right? So we understand that you need to test things. So I'm not
Yeah.
looking at you to have, a crystal ball. I'm just
Yeah.
curious to know what are you going to test and how does this come about, right? I think that's what we're getting at here.
Mm-hmm. Yeah. I mean, you were bringing up question number 4, which is what if?
Mhm.
Um, and exactly what, as you're saying, the savvy investors are critical thinkers. They might, as you're pitching them, they're probably thinking of an alternative scenario to the one presented. And probably they're thinking about how can this founder make the most of the capital that I give him and give us back the biggest return on that investment, right? And so it's hard to predict the what if scenarios, but some questions that you'll be asked, you might get asked, is like, what if we invested 6 million instead of 10, right? Which is kind of the example that you were making before. How does that change your growth plan? How does it change your cash flows? What if you started offering a free trial period to boost adoption, right? And then you convert some of those free users into paid users for premium features. What if you switch from a in-house manufacturing to a contract manufacturer or packer, right? Or vice versa. Um, so these are things that can come up. If we have time, maybe a quick example of there's a coffee marketplace company that we raised a Series A round a couple of years ago, and we were talking to the lead investor, and they asked, uh, what if we invested 15 million instead of 10, which is the opposite of the example that I made. And what if we slow down on the hardware manufacturing, the coffee maker manufacturing, and invest more in building the community? And I remember that the CFO and the CEO had a session with the lead investor on screen with the financial model that we created, and they were able to adjust those dynamic drivers that contribute to change in the projections, right? And observe what happens to the cash flows. When do we run out of capital now? Can the business absorb more capital than initially planned? What happens to the margin, and so on? So this is to say that it's impossible to predict the specific scenarios, but first of all, I think we all need to train to have a flexible mindset, right? Especially as we venture into working with others, other investors or partners. And secondly, we can be prepared with a dynamic financial model that supports this type of conversations.
That's what I was going to get at. I think we're alluding here to the financial model. To you guys,
Yes.
a lot of times in the financial models. I was going to ask, how do we start to answer those what ifs if we don't know what those what ifs are, right? You'd made one great comment here, which is that the VCs are thinking while you're talking. And
Yeah.
for anyone out there listening to this, when you're pitching, be well aware that your audience is thinking about many other things beyond what is actually coming outside of your mouth. The second you say something, a VC is going to, their brain is start going in different directions. And this is where all these what ifs start to come about. This is where they say, okay, well, what if they're running all these scenarios. So by the time you're done talking, most likely this VC is going to come back with some questions. They're going to pepper you with a lot of what ifs.
Yeah.
Question to you, Antonio, how does the entrepreneur get ahead of some of those what if questions that could be coming down the pipe well ahead of time before they get in front of the VC?
Mm-hmm. Well, so I think a general rule when we build these financial models here at growthink and growth capital is to build them with dynamic fields. So any input to the model, any pricing input, cost, and sell the model that has an impact, a substantial impact on your numbers, should be an assumption, right? It should be something that you're able to change easily, because that gives you a very easy tool to play what if yourself, right? And you could probably guess them because, from the most common ones, right? What if my cost of sales or cost of goods sold goes higher than expected, which is what has been happening in the past few years, right? What if there's a price resistance to my final price or retail price and I have to lower it? What if I can't hire that role for that salary and it's going to cost me more? These are maybe negative examples, but they're very common examples of drivers that, as you adjust them, they will show you maybe lower margins or more time to profitability, right? At the same time, there are things such as the number of your customers, the size of the orders. Those are very hard to predict until you have some, right? And they continue to evolve. So having those fields that are either made dynamic or using a number of avatars to give a closer representation of what the target markets, the target customers are, it's going to help you do that type of what if scenario analysis.
Yeah, and I agree with starting with the basics. I like how you phrase that, which is just start with the basics. That what if your costs go up? What if your marketing isn't firing at the level that you thought your marketing was going to fire at? What if it takes a little longer to get your sales? What if you burn through a little more cash? Like these are really good.
Yeah.
And I don't think you need them on slides, but you definitely want to have them in your back pocket. So I want to do a brief little recap here. So we touched upon market opportunity, just in general, knowing how the market is shifting. Is it trending upward? Is it trending downward? What does that mean to you, and how are you positioning yourself inside of that market? Talked about traction, which is the progress that your business has made already leading up to this conversation and how you present that. And traction could be a lot of different things. We talked about multiple points of momentum from the early stage companies. Then we talked about this big how, which is the technical aspect, like how is this all going to work? Not just sales and marketing, but sales, marketing, product, distribution, finance, team, the whole bit, knowing your inside and out of your business. The big what if things don't work? Everything you've presented to us thus far sounds great, but what if these aspects don't work? What is number 5? What's the top 5
Well,
question?
we left it last, I think, because it's the toughest one, right? And I think it's the toughest one because most investors won't ask it directly, or they won't ask it at all. And the question is, why you? If I can summarize it in two questions, into words, why you, right? And this is what is so unique about your brand, about your product or service, and most importantly about your technology and team that gives you an unfair advantage to take over the market, despite all the many challenges that they are already in the market. Okay, and obviously it's an overarching question that it requires probably multiple articulated answers, but I'm convinced that the answers start shaping up in the investor's mind very early on in the conversation, possibly long before you even talk to an investor, right? They receive a teaser, they go on your website, they review your deck, or you pitch them, right? And they continue to develop their idea on why you. And to me, the first way and the fundamental part of answering this question is having a clear definition of your company's unique identity. Okay, what is so unique about your company that nobody else does? What makes it so unique to deliver value to your customers in a way that others players in the market cannot do? And I got a quick example here if we have time. We raised capital for another company this year that essentially provides IT services and enterprise software to the telecom industry, the banking industry, mostly for digital identity verification. And the way they presented themselves when we started working with them was essentially through a very comprehensive grocery shopping list of services, or compelling services, but it completely confused the identity of that company. Okay, and so they were basically trying to present themselves as capable of serving 14 different industries in a number of markets at different stages and verticals. With the result that for them and for the sales team was very hard to even articulate what they do. So we spent the first month of our work through the strategic planning. We studied those markets and those opportunities, and we found that some of those opportunities, although sometimes they were able to make a sale in that industry or vertical, they weren't really worth pursuing due to the niche nature of it. Some were very distant from their core expertise. And so we refined with them their offering, their unique value proposition to 2 or 3 things, right? They redid their website according to that. The sales pitch changed, and they were suddenly a lot more clear about who they are and what they do. And only at that point, they were actually able and ready to pitch investors. And investors got along with that very linear proposition and ultimately decided to partner up with them. That's maybe a little example that summarizes the point about why you. There's obviously more things. How unique is your technology? Is it proprietary, or are you using some commoditized third-party technology that everybody has adopted by now? How does it enable you to serve your clients better, faster, cheaper than anybody else? And then a huge point about the team. It should be much earlier in this podcast, but is the team laser focused on this company, or are they working on other side gigs? Have they done it before? Have they grown a company to substantial scale? Have they sold a company? Are they going to stick to this for 10 years or so? Because that's how long it might take for an emerging company to an exit, right? And if market condition changes, are they going to be able to pivot the business model?
So you covered a lot of territory there. Let me kind of paraphrase a little bit. One of them is if you are confused as an organization, if you're seemingly confused to the outside world, you're definitely going to be confusing to an investor. So that is the first and foremost. It's knowing how to communicate about yourself in a way that's not confusing. Even if your business is a little bit chaotic and a little bit confusing, it's still your job to find a way to simplify your message and get that out. As much as it is your job to simplify your organization, that might be harder. But when you're getting in front of VCs, you only have them for a split second, and their attention is it's gone. So if you're confusing them, that's going to give a little bit of trepidation. One last question I want to ask on this why you aspect, and it's a personal one, which is why you the business, but then why you the founder. And you and I both know that the founder that got the thing started, they say you kind of have to be 3 or 4 different types of CEOs throughout the journey, or more appropriately, the business might need 3 or 4 different types of leaders throughout this journey if it's going to hit new levels. The why you aspect of a founder, why you are you the one who's going to take this thing to $1 billion? And you made a great point early on, which is sometimes the VCs won't even say this. This is a big one because sometimes they may just think it and then never even say it. So how can someone be prepared to be the right why you?
I mean, that's extremely difficult for us now, but imagine for a founder, right? It's about recognizing that you may or may not be the right person to grow the company that you founded, that you know better than anybody else. So I think it's very personal. It's very difficult. I've seen lots of founders that are maybe in a president role, in a more philosophical, strategic role, and a little less on the execution. This usually, my experience, happens a little bit later. A lot of what I'm talking about now is Series A, Series B. I think a lot of people that follow us and that they want to work with us, they're maybe trying to raise the first institutional capital round or the second one. I think as companies get bigger through growth, scale up, private equity transactions, it's even more common to see the change or replacement of management. I think in the early days for me, and you might disagree, but it's more about making sure that you're covered on the areas that you're weaker, right? I may not need to change the CEO, but the CEO that in the early days was doing sales, HR, strategy, right, and tech, well, that person needs to understand early on that it's a job for 4, most likely, right? And there's maybe 3 people that are better qualified than him or her to oversee that area of business that is becoming increasingly complicated. So, and that might be somebody in-house, it might be an advisor or a consultant in the interim, right? It's about what works better for that particular time and place.
Yeah, that's a great point. So again, taking it from the top, knowing your market opportunity, knowing the traction that you have made thus far and that traction that you need to make, how to do the thing technically within your business that's going to take it to the next level once you receive that capital, what your contingencies are if things are not working, and why you the business and why you the entrepreneur that's going to take this thing forward. Antonio, very, very intriguing conversation here. How does someone work with you if they want to work with you directly or reach out and get in contact with you, find you online?
Yeah, absolutely. You can reach out directly to me through LinkedIn, Antonio Barzagli, or email antonio@growthink.com. There's many of us. We work as a team, so we'll feel free to reach out to our company, and we'll be happy to talk. I also want to say, first of all, thank you for listening to this long thing. If you have comments, if you agree or disagree, you want to share your perspective or experience when raising capital, working with VCs, I think you can post comments. If somebody's interested in going deeper on any of these themes, and team invites me again, I think we can do that. So that's all. Thank you very much.